Good evening, Dr. Samiran Chakraborty. Welcome to Harass's meeting. I hope you've had a great time so far.
Thank you for inviting me. It has been a pleasure.
Dr. Chakraborty, all through the day I've had many conversations with business leaders and policy leaders, and one of the top questions they asked me was the extreme pressure that the rupee has at this point, touching to be 59.60. And the trillion-dollar question they kept asking me, or for that matter, many business leaders, is, do you think the rupee is going to go to 65, 70, where it's going to stop? Now, we know some of the reasons, but I thought you being from the research side and being the chief economist, what is your insight and perspectives about this exchange rate pressure that India is going through for the past almost 1 year now?
Sure. So whenever we look at the currency, there are a set of local factors and there are a set of global factors. Particularly if I first talk about the local factors, the way I describe the Indian economy today is it is a combination of 4 fives. Mm-hmm. What I mean by that is growth is at 5%, inflation is at 5%, fiscal deficit is at 5% of GDP, and current account deficit is at 5% of GDP. Now, I don't recall a single episode in the world economic history where a country faced a currency run on the back of 4 fives. Mm-hmm. So from that perspective, we don't think that local factors have been primarily responsible behind this current episode of rupees run towards 60. It has been primarily driven by global factors. And within global factors, what we have observed till now is only about $4.5 to $5 billion of bond outflows on the back of fears that Fed will take off the quantitative easing later in the year. What we haven't seen as yet is equity outflows. Mm-hmm. And if that's the next shoe to fall, then in our view, there is a possibility that rupee could head towards 63, 65 kind of levels also on the back of that equity outflow. Because let's not forget that rupee is primarily an equity flow driven currency, less of a debt flow driven currency.
Absolutely.
However, in our view, it's also the case that the RBI has been intervening strongly in the currency market in the last few days. And there would be some speculators in the currency market who will play for a mean reversion trade on the currency, where they would think that, well, in one go the currency has moved 10, 12%, time to take profits, and you could see a retracement coming back as well. But overall, it seems that now the new pivot level is becoming 60 rather than 55, which was just a few months back.
You brought in a very, very insightful and interesting perspective on the depreciation, on the pressure that rupee has, not just from internal issues that everyone talks about, but also external issues. And the underlying sentiment is of the comfort zone or the flight or fear that you talked about. But you said it could go to 65, but do you think, are we talking about a 6-month or a 1-year time frame, or is it more near term? I know it's difficult. I wish we had a crystal ball, but
Well, in our view, the likely depreciation impact will be closer to today, because this is when the market is repricing the risk of QE tapering. Mm-hmm. Probably in the course of the year, people will find that, one, the QE tapering might not be as much as the market was anticipating. Two, the impact of QE tapering might be counterbalanced by easing by Bank of Japan, mm-hmm. or even for that matter, it is only tapering. It's not actually sucking out liquidity from the central bank's part. So all these issues we will get to know probably 3-6 months down the line. These will become clearer. But what is happening today is the risk. And if that risk really triggers an equity outflow, then there is a possibility of rupee overshooting its so-called fair value.
This leads me to my second question. That's also even more insightful in terms of, I'm sure there's a big dilemma in the government of India, policymakers, financial institution, bankers for that matter, is, on a higher interest rate, you're choking growth. You try and reverse that, there will be capital outflow, putting maybe more pressure on the rupee. driving more inflation. Now, how do you think this is going to play out, both from a policy perspective or from the industry perspective? Because we seem to be in a state of flux, and going one way or the other doesn't seem to be a very clear path. It's got to be a mix of various interventions that we do. What's your take on that?
Well, I'll break it up into two sets of issues. One is on what the RBI should do. Should it cut rates? Should it not? And the second is how bankers would respond to it. If I go to the first one, let me be very clear and upfront in saying that I'm in favor of rate cuts. My point is very simple, that if you look at our types of flows that we get, as I was mentioning, equity inflows are much larger than debt inflows. So even if we lose a little bit on debt inflows, but if the growth outlook improves on the back of those interest rate cuts, we might get more equity flows to compensate for that.
Mm-hmm.
The bigger question to RBI's mind is that whether growth will actually improve or not when they cut rates, because of all the supply side issues that have been plaguing India for a while. Well, I accept them, but to my mind, the bigger issue in India today is of lack of confidence.
Mm-hmm.
And interest rate cut could be an interesting tool to revive that confidence.
Mm-hmm.
Also, let's not forget that today the leverage that is there in the corporate sector and the associated risks along with it, if interest rates stay high for too long, then you could see the domino effect coming in, affecting not just corporate balance sheets, but as well as banking sector balance sheets. So in that sense, running the risk of high interest rates for too long is like playing with fire. So in my view, we have the scope for reducing rates. Just as a comparison, I put fiscal year 06.
Mm-hmm.
That was the time when inflation was 5%, growth was 9%, policy rate was 6 to 6.5%. Today, inflation is at 5%, growth is at 5%, policy rate is good 100 basis points above that. So there is a case for interest rate easing. Now, what happens to banks? The big question is that RBI has cut interest rates 125 basis points. Banks have hardly cut their lending rates by 25 basis points. There, the challenge is that the domestic system is starving of rupee liquidity. And that's the reason why bankers are unable to pass on the entire rate cuts of RBI.
To the end user, to the client,
users,
yeah,
exactly.
okay.
The other problem is the guidance of RBI. Even while RBI has been cutting rates, their guidance has been pretty hawkish. In such a situation, it becomes very difficult for banks to imagine that there will be more rate cuts down the line, and on that basis ease their own interest rates. So that's why we are in a situation where bank lending rates, deposit rates have not declined, whereas the policy rates have probably come off. And I expect that there would be still more delay in passing on these RBI rate cuts by banks as we move forward in the year.
Okay. The other very big question, and everyone talks about India, and the first thing that comes to their mind is about the huge lack of infrastructure that India has, which brings us back to the money part of it. 12th five-year plan, I believe they are talking about $1 trillion that they need to do funding of the infrastructure. They talk about half of that, $500 billion, to come out of the private sector. Now, these numbers to me sound very tempting, very flirtatious, very promising, encouraging, but my concern is, where's the money? And where's the money going to come from? And it sounds good. We can write on an encouraging note that we'll do $1 trillion, but where's the money? And where's the money going to come from? So you have any thoughts on that?
Well, on a side note, whether it's 1 trillion or not depends upon what exchange rate you are taking it in.
Well, which brings us back to the question of whether it's 60 or 65, but let's peg it at 60
Exactly.
for that matter.
So at 60, it's not going to be $1 trillion for sure. But that aside, when it was actually $1 trillion in the current exchange rate, we did some analysis, and it was very clear to us that we do not have enough domestic savings to get channelized into this kind of investment. So on a broader basis, we can say that we need at least $300 to $400 billion over this period from outside the country to fund this.
Mm-hmm.
And there it becomes very clear that we not only need debt capital but also equity capital. So both FDI needs to be encouraged, as well as we need to find better ways to get foreign debt capital into this country, partly through banking channels and partly through maybe even corporate debt channel, where we have to have a relatively more vibrant corporate debt market which can bring in foreign debt. Let's accept that India's overall debt, if you take foreign investor penetration, it's very, very low at just about 3%, against somebody like Malaysia, which is at 47%. So there is a large scope for penetration of foreign investment into debt, which we need to encourage as we go forward, without becoming extremely indebted, obviously. But that is where the balance needs to be struck. We just do not, even with 30-35% of savings rate, which is very high compared to global standards, we still don't have enough resources to fund this $1 trillion investment dream.
So I think your take on this is reasonably encouraging, that we will find the money over a period of time to fund this $1 trillion or maybe $800 billion if the exchange rate changes. I'm going to be asking you one question which is very close to my heart all the time, is Indian economy and a lot of economies in the West, including in Europe, fundamentally a lot of it is based on small and medium enterprises from a point of view of the employment base they offer. And from the point, I remember the 90s, India's deposits were down to $3 billion or something. And you know, the one sector that never drew upon the dollar bank deposits was the medium and small enterprises that were exporting and bringing in hard currency as the word would be at that time. Whereas the large corporates would look for dollars because they had to go out and acquire and so on and so forth. So as a bank, Standard Chartered Bank, is there a certain allocation that you guys do or are thinking of doing which is very, very specific to the Indian enterprises and the SME sector, or it's a cross-platform, all rates the same for everyone? Or?
Well, obviously we have a specific team which deals with the SME funding, but before I come to that, let's just get this perspective right on SMEs. And it's very, very important that SMEs today contribute to 45% of India's exports and 40% of India's industrial output and about 12% of India's GDP. So it's a very important sector, but it's also very important to understand that there are about 30 million SME enterprises, out of which, in the organized sector, only 30 million, out of which only 90,000 are so-called registered, so to say.
Okay.
And 94% of these SMEs are kind of proprietary. And there are another 30 million which is in the so-called unorganized sector. And then you have shops and establishments.
Which is beyond this 30 and
this.
30 and then beyond
Yes.
that, obviously.
So effectively, you can show that 1 out of every 2 households in India is an entrepreneur of some kind.
Of some kind, whether it's a single man or it's a 1 to 2 persons. Or,
Exactly.
Okay.
Now, in such a situation, for a bank of Standard Chartered Bank's size, which is just about 100 branches in the country, to service this extremely disparate population of enterprises is not an easy task.
Of course, it's even for the state government banks, it's crazy, which have, we have 8,000 branches.
Yes. And that's why we have ended up in a situation where only about 1/3 of this SME pool can access formal finance. It is an unfortunate situation, and government is taking some steps to incentivize finance going into SME. But what we are seeing also is that because of certain incentives given to SMEs, SMEs want to stay SMEs. And they don't want to become larger firms because then they will lose those incentives. So it's a catch-22 situation.
Are you referring to preferential treatment in regard to excise duty, turnovers and things like that?
Absolutely.
Okay.
And also labor mobility, hiring, firing restrictions, etc., etc. So that's an interesting catch-22 situation at a policy level we have, that on the one hand we want to encourage investment into SMEs, on the other hand when they're getting these incentives, they're not becoming larger in scale where they can generate the economies of scale.
Well, you know, this is where my thoughts on this have been that anything that is driven by subsidies or some preferential treatment it really doesn't work out well on long term. It distorts the entire market. I would rather that there are no preferential treatments given in regard to excise duty benefits or sales tax or write-off or tax, but enough liquidity, enough lending so that they get a fair play and compete with the best of best in the world and grow and not stop themselves. It's like choking your own growth. I don't want to go beyond this point because I'll get excised. So I would rather go that way, and it's good to, I know it's a mammoth task, and I hope that there was a interbank coalition or collaboration happening to fund this kind of thing. Because one of the things in India that we feel every day is a lack of liquidity, and everyone's like complaining. I'm not sure to what extent it's true, how deep it is true, but there is a complaint that there is lack of funds, and they have projects, but they don't have funding by the bank. It's a catch-22. Now,
not just debt funding, it's also equity funding.
Equity funding. I said, you bring collateral, we'll give you money. I said, how can I bring collateral if I'm an SME and I have to grow? So it's a catch-22. I'm sure we'll address that over a period of time. Well, I think these were very insightful things from a bank perspective. I know some of these things would make some of the viewers and listeners happy that the banks are looking at the 360 perspective. I hope you have a good time here.
Thank you.
We'll look forward to seeing you again in one of these events.
Thank you.
Thanks a lot.